Good morning and welcome to the weekly Market Mondays webinar. My name is Kyle Rutter. I'm with Danny Haythorne, we are both senior market analysts at capital.com. Danny, good morning. How are you going?
Good morning, Kyle. Good morning, everyone else. Welcome back. Another Monday here, joining us to see what's been going on in the markets, and a lot has been going on. So, Kyle, let's get straight into the risk warning if you want, and then we can get in with the content, which I'm sure everyone is eager to see.
Yeah, of course. Well, I'll just say my bit first, which is to say that everything that you hear here today is of a general nature only. It doesn't take into consideration anybody's personal circumstances and therefore should not be considered personal advice. Obviously, do your own research and also consider if CFDs are an appropriate product for you. And of course, you've got a little bit to add, Danny, on the UK side of things when it comes to getting to.
Yeah, it's just to say that obviously for those of you in the UK, aside from CFDs, we also offer spread bets. Again, they are high-risk products, so make sure you are aware of these products before you trade them and just understand the complexity of them. Quickly, let's go over the key themes. There is quite a bit to talk about. From the offset, anyone who's looked at the markets and charts this morning will have seen that August have kicked off with a strong reversal in markets. We saw this happen last year as well, which is quite interesting. Different reasons back then, but similarly tied to some extent. But most of the reversal coming from those disappointing US jobs data sentiment. So we've seen a lot of the momentum turn. We've seen it in the dollar. We've seen it in equities. As a result, we've seen, for example, safe havens like gold recover some of that momentum, which had kind of been dwelling over the last few weeks. So we've seen some moves there. So that has also led to markets now pricing in a rate cut from the Federal Reserve in September. And that is despite we had the FOMC meeting last week. They reiterated their wait and see approach. They didn't really give much insight as to what to expect, but definitely the data has caused some concerns about growth and the outlook of the US economy, and that has spurred markets to now price in 2 rate cuts before the end of the year, with a total of around 130, 140 basis points of easing from here until the end of 2026, taking the rate potentially all the way down to 3% in the next year or so. So definitely a lot of shift in sentiment in this week. We'll cover that. And then, of course, we have the Bank of England this week on Thursday. They are expected to cut rates, and we'll do a little bit of a preview on that. Kyle, do you want to kick it off with your initial thoughts?
Yeah, I mean, jobs data was weak. Clearly now stokes fears that maybe the US economy is slowing down. Obviously, a big factor there in the market reaction on Friday night was the revisions to previous months. So it's suggesting that this kind of assumption that maybe the US economy was fairly resilient and managing to hold up fairly well despite the uncertainty of US trade policy could be somewhat misplaced, and that markets are now having to discount effectively a weaker economic outlook. You could kind of get a pretty good sense of, what the markets are looking for at the moment as far as data goes, because it was certainly a situation where bad news was treated as bad news. We do have the Fed now, or the market's pricing in that the Fed will, more than likely cut in September. Markets also lining up a second cut after that before the end of the year. But of course, we still saw equities down. Naturally the US dollar dropped as you would expect in those situations. Gold was high with yields lower as well. The other element too, of course, is what happened with the August 1 trade deadline, which was sort of a double whammy on Friday. Basically, the average tariff rate on US imports is going to be a little bit higher than previously thought. Initially, after the April 2nd or April 9 backflip, the commencement of the TACO trade, there was the belief that maybe tariffs would be in the low to mid-teens. As deals came through, markets sort of adjusted that maybe the average rate would be about 15%. Last week, while there was leading up to August 1 a few trade deals, obviously the one with Japan was a really noteworthy one. Managed to get the average tariff rate down to about 15%. Clearly there's also the deal with Europe, which despite its shortcomings, saw a tariff rate that would have been a little bit lower than certainly the 30 and even 50% tariff rate that was threatened for a little while. But on Friday, India, higher than expected tariff rate, I think about 25%, some of it punitive to punish India for purchasing Russian oil, and obviously its strong strategic relationship with the Russians as well. And then there was also the 35% tariff rate on Canada as well, with exemptions from carve-outs with USMCA. When you combine that with the fact that we've also seen the Trump administration opt for a 15% baseline tariff rate on countries running a surplus with the United States. Countries that aren't running a surplus will have a 10% tariff rate. All of that nudges up the average rate on US imports to about 18%, give or take, at least where we are right now. And now those tariffs are going to be applied on the 7th, which is obviously Thursday this week. And it begs the question whether the growth shock that was being priced into the market has to be a little bit larger than previously estimated. And then also complicating that is that we did have those inflation figures, the PCE data last week that was a bit higher than expected and suggested that, you know, the pass-through from existing tariffs is starting to materialize. And that, again, with tariffs being a little bit higher at the margins than previously thought, that price shock might be a little bit larger. The Fed, in its recent summary of economic projections, gave us a bit of wriggle room when it comes to, you know, what it's willing to tolerate regarding higher inflation. I think the projection for December for the core PCE is around 3.1%. So still room to move there. But nevertheless, it does seem that we're at a point now with markets are having to price in, again, a little bit of a larger shock from tariffs, that the impact already from tariffs is material enough to slow down the US labor market to where it is seemingly in July, from based on the data that we got on Friday night. And as we've been saying for probably a few weeks, maybe even a month now, because I think started to have this kind of conversation leading into the initial July 9 trade deadline, is that there was a lot of reason for markets to continue to buy into good news because the taco trade and, you know, trade deals were coming through at the time, and that was taking some risk off the table. I should say leading some market participants pricing out some downside risk. We are, and still were, in a situation where valuations were reasonably rich, positioning was getting a little bit stretched, and markets were going to be sensitive to bad news, and that's what we've got. So, you know, you get the sense now that a little bit like last year, which I think ironically it was the July jobs numbers that started to really stoke concerns about recession and prompted the first interest rate cut from the Fed, that we could be heading for maybe a bit of a seasonal soft patch, if nothing else, for equities, notwithstanding that we did get some solid data here and there, not with, you know, including some of those tech results last week. Danny, I don't know if you've got any further to sort of add to this discussion there when it comes to what happened last week and how it could impact things going forward.
Yeah, I think we've got an interesting dynamic because, as you say, we've been knowing that there's a lot of downside risk for a while, but it just felt like equities were so strong. And they were backed, as we said, prior a pretty solid earnings. I think if you look at the earnings season that we've had so far, I mean, maybe excluding the big tech, because we know that they kind of play in their own league a lot of the time. We've seen a good report, but I don't think it was stellar. I think you've seen the general feedback is that, yes, you've seen robust earnings, we've seen some growth, and I think that limits a lot of the downside. But I think if you were looking maybe for like stellar outperformance or a reason to want to find more bullish appetite in markets, I do think that to some extent the earnings season was good, but I don't think it was I think it's been outstanding. And but nonetheless, market momentum was very good. We knew that economic data was strong. We knew that the Fed had no reason to cut rates because there was no real threat to the economy. We knew that Trump was behaving to some extent, but that left markets exposed to the downside. But interestingly enough, and I'll share my chart. I'll share the charts now. We are actually seeing equity markets again trying to move higher this morning, trying to reverse some of that losses that we saw on Friday. You can see here just a general outlook. We've pretty much got the same momentum in Europe up here. We've also got some of these US stock indices, the Japan as well, the Nikkei. So we are seeing investors wanting to take advantage of any pullbacks to try and be a buyer at a more favorable level. So there's definitely interest to be a buyer still, even though we've seen the labor data come in worse than expected, especially with those big revisions. And we've also seen a very Trump move out of this, and he supposedly fired the head of the Bureau of Labor Statistics after the data. He justifies it that this person, this woman, was handpicked by the Biden administration, that she'd falsely reported data leading up to the election campaign to make his numbers look better. Nonetheless, he's fired this person. And again, it brings another layer of political uncertainty at a time when he's gone head to head with Jerome Powell, the chairman of the Federal Reserve, several times. So again, markets have reasons now to be concerned. Do I think it's a reason to be a ride out seller? No. Clearly, there's a lot of still buying appetite in the market, but there's reason to be concerned. The data is now also playing to that factor, which was something that had been, kind of the outlier up until now. So it's going to be interesting how markets evolve in the next few days. We don't have a lot of data coming out this week for the US. So it may just be a case of, again, relying on headlines, as you said, some of those tariffs are going to be applied this week, how markets react to that, and also how some of these remaining companies also report. But yeah, to me, it's just interesting. I think we've seen in the last week, we've seen a shift in mentality, and think we've clearly seen that in markets, but investors still resilient to be sellers in some of these key shares in some of these key areas, because there is still a lot of appetite, there's still a lot of strength in the economy, even though we are starting to see those pockets of weakness creeping in. And of course, that has led to markets now expecting the Federal Reserve to cut rates in September. So yeah, there has been quite a lot happening. If you want, I might just start off here quickly with the Bank of England, because we do have the meeting on Thursday. They are expected to cut rates by 25%. The Bank of England is in a little bit more of a tough position. I think they're kind of in the perfect middle ground between the ECB and the Federal Reserve, in the sense that their economic data looks more like the ECB in terms of slower growth and to some extent stagnant inflation, but they've kind of remained pretty stable with their cutting cycle like the Federal Reserve, and they've kind of stuck to one cut per quarter up until this point. So it kind of fits in with their dynamic. But we have started to see weakness in the economy, in the labor data, whilst inflation remains sticky. And I think it's left the Bank of England in quite a tough situation, specifically with fears of stagflation. So it's going to be interesting with this meeting, not only the fact that they are expected to cut, and I think they will do so, but how that vote split's going to happen. It's likely we get another three-way vote split, not in the sense that we get cut, no cut, and hike, in the sense that I think we're going to get some people voting for unchanged, maybe one or two dissidents. But I think the real interesting factor is going to be, how do these how do these MPC members place between 25 and 50? And I do think we may have a few leaning into that 50 category, because they are concerned that maybe rates still are too high considering the outlook of the economy. But of course, it's going to be tricky to balance that, because we do see that those inflationary pressures creeping through. Now, a lot of those inflationary pressures are coming from the services sector, which tends to be quite hard to read sometimes. And if we're looking at the health of the general economy, maybe it's a little bit better than expected if we take out those service sector data. But we are definitely starting to see cracks. And I think it's going to be interesting to see the commentary that we get from the Bank of England, but also that vote split, and how many members are leaning towards a greater vote split, and how that's going to change expectations of future monetary policy decisions.
Yeah, certainly. I mean, obviously, I normally leave it with you when it comes to the Bank of England, but it's a pretty invidious position to be in, with inflation with a 3 in front of it, and basically the labour market softening and growth fairly anemic. So more or less, you're going to get a cut this week, almost certainly based on markets pricing, almost certainly based on the economist surveys. But the UK is dealing with things that are not counter-cyclical. They're structural problems, and the tweak to interest rates is probably not going to do much other than take a little bit of pressure off households eventually. Although I did see again, Danny, obviously being an Australian myself, I'm mostly covering off the US news as it comes overnight, and not getting as much exposure in the past to the Bank of England. A really interesting article that I read in Bloomberg last week about the slow pass through to households who are obviously under pressure from a rising cost of living, effectively, from interest rate cuts so far. That is to say that deposit rates have dropped, so those who are savers are not making as much money on their savings. But because of the structure of the mortgage market over here, the pass-through in terms of interest rates, as far as just household consumption and household balance sheets, actually hasn't come through yet. So people are still, doing it reasonably tough, despite the fact that we've seen 4 cuts over the last year or so. So yeah, it's a tough position for them to be, and it looks like they'll cut rates. The short-term volatility will be in effectively whether they go again a couple of times. not well before the end of the cycle, certainly once more before the end of the year.
Yeah, I'm also just bringing this back to markets. It's gonna be interesting to see how much of the decision or how much of the commentary that we get from them is actually going to be able to translate into some market momentum. Specifically, we're looking at the pound, for example. We may see some more momentum in pound, euro sterling, or maybe even pound yen, because if we're looking at cable, which is pound dollar, it has been very much dominated by the dollar side, and I think we can say this for the majority of the dollar pairs recently. And I think the pound has struggled to find some support over the last few weeks, and I think a lot of the structural issues that we've mentioned has weighed on some of these UK assets. But we can clearly see that the dollar reversed on Friday, as you can see in this chart here on the left, attempting to regain some momentum again. But it was coming from quite a position of strength after touching some of those really lows that we saw recently. If we're looking at cable specifically here, you can see we've seen that downtrend really kind of pull back here, come down below 132, not quite managed to get a close below it. So clearly interest from some buyers here, but we've kind of broken through some key support levels, one of them being that ascending trend line from the lows, the ascending lows from the beginning of the year. We've also dropped below some of the key moving averages, the 100-day being a key one just last week. So clearly we've got, as we said, some structural weakness that's weighing on the pound, but we also have the RSI nearing those oversold levels, managing to pull away from it on Friday as we saw that reversal. It's going to be interesting to see where we go from here, because clearly the dollar is starting to see some more weakness or change in that short-term momentum that we've seen, but also the pound has definitely weakened over the last few weeks, and the appeal to be a buyer into the pound has softened as well. So it's going to be interesting to see whether any sort of commentary from the Bank of England, any reassurance about the path of rates and how they plan to revive a struggling, I wouldn't say struggling economy, but definitely an economy that's showing cracks whilst managing inflation. And I think that vote split is going to be very key, and that's going to maybe derive some of the momentum in the pound this week.
Yeah, without a doubt. I mean, I think that dollar starts sort of side of the story is really interesting too. Like you said, it might be a better trade for the BOE, might be on say the Japanese yen or the euro pound realistically. The yen being interesting, obviously, because we had, the Bank of Japan amongst all the other things last week, and they just don't seem to want to, be too active when it comes to policy rates, despite the fact that they're clearly having inflation issues over there, maybe even more sustained inflation issues because fiscal settings. But just on the dollar really quickly, just because it will ultimately drive the fortunes of the pound or of the cable. Interesting inflection point, because we've got a fundamental story which, from a cyclical point of view, suggests that the dollar should probably weaken again and continue this downtrend. However, I think we're starting to see signs that markets are under a degree of stress. So financial conditions are a little tighter than they were a few weeks ago. And on top of that as well, you've got a weaker euro, a significantly weaker euro, really on the basis that that trade deal took the steam out of that kind of, very pro-euro trade, partially because I think the package of funding that the Europeans have pledged to direct to investment in the United States really takes away some of that fiscal capacity that I think many sovereigns were going to use to try and boost the domestic economy. And that's why the euro was rising so much, was effectively just the expansion of public balance sheets to fund remilitarization as well as other fiscal spending, which, especially in the case of Germany, our market participants have been hoping for years. With that weaker euro, US dollar, despite strengthening because of tighter financial conditions, and despite the kind of potential weakness, weak macroeconomic backdrop emerging, there's a real repositioning that I think could be going on at the moment, which, I still think that the US dollar is a kind of a bearish story in a longer term time frame, just because of the test that US debt levels, the test of institutions that Trump is basically doing, so to speak, as well as obviously this sort of trade policy and trade uncertainty. There's this huge repositioning seemingly going on, which could, maybe form a little bit of a base underneath the US dollar, drive obviously US dollar pairs. And then on top of that too, maybe we can dovetail into this as well, because, someone will inevitably ask about it. it also, potentially caps gold's upside too, because if you look at the flip side of the sort of long dollar trade, sorry, I should say the short dollar trade is, more or less a long gold trade. And so although we've sort of seen a little bit of support through there at sort of, 3,300 and, arguably at the 100-day moving average, if we get that kind of repositioning in the US dollar, which is normally just a short-term dynamic, as basically markets balance out a little bit, that could also mean a deeper pullback, in gold. Follow the technicals, of course. 3,200 is the key level to sort of suggest a deeper breakdown and a break of the uptrend. But another one that could be really worthwhile watching as we start to sort of tackle these, really big concerns about, a slowdown in the US economy and, what that might mean, what that might mean for asset prices across the globe.
Yeah, it's going to be interesting. We've been talking about, well, we talk about gold every week. I think we love it. Everyone loves it. There's always something to say. But we have been talking about, some of these key areas of support, how gold has been weakening, but also pointing out that at a time where the US dollar, and I mean, if we bring up the chart of the dollar index, you can see how much strength we saw in the US dollar that past week. So let's say here from mid-July, we didn't actually see that. I mean, we obviously saw some weakness in gold, and that led to that breakdown away from that symmetrical triangle. But the sell-off has been quite contained to some extent, and I think that once again speaks or alludes to the fact that fundamentally, and we've said this several times, fundamentally there's still a lot of appetite in gold. There's so many tailwinds in terms of central bank buying, in terms of diversifying away from US dominance, in terms of expected rate cuts from the Fed. And now, of course, we're at a time where we've all kind of known that the Fed was going to cut rate. We were all hoping that the Fed was going to cut rate soon, but it just seemed to get further and further away as data was strengthening, and especially the Fed had to focus on potential follow through of tariffs into inflation. We're now at a point where after the data last week, markets are now more convinced that the Fed is going to cut rates in the next few months. And of course, that's given gold another push higher. But it's going to be interesting to see as well how much higher gold can go, because we do still have that momentum coming in through the dollar. And of course, we still have some resilience in markets. You can see equity markets. They have started to reverse from some of those all-time highs, but they're still showing strength, and there's still appetite to be a buyer in some of these equity markets in the US, in Europe, and in Asia as well. So that's kind of limiting some of the upside for gold as well, at a time where gold is around $3,400, which is in itself a pretty remarkable level considering, and I mean, we can zoom out here, where we were a few years ago. I mean, even 2000 seemed like a stretch back then. So gold has the value of gold has increased significantly over the last 2 years or so. And even then at these levels, there's clearly still interest to be a buyer. So I think that speaks for the long-term momentum of gold, that it's still something that people value to have in their portfolios. And there's always, I wouldn't say always, there's going to be appetite. There's likely going to be appetite in the future as well. I think since we're talking...
Oh, yeah, sorry. No, I was just going to say that just as a very cursory point was that, yeah, the moves that we could be seeing at the moment might not change the sort of structural trends in the markets. Gold, I think, is still bullish in the long run for the reasons you just outlined, Danny. Equities probably will find a degree of support if they were to even drop 10 to 15% as reason to buy it. It feels to me with the dynamics that we've seen over the last couple of weeks that maybe we're hitting one of those sort of soft periods where sentiment is a little bit dire and that some air needs to come out of the markets, reprice a little bit. Gold's a part of that story, I think. The US dollar could be a part of that story, and equities would be a part of that story. Doesn't necessarily change. I don't think at this point we're seeing a change in the long-term narrative, but one that really could see, fairly significant volatility over the next few months, and basically some counter trends. But again, you got to follow the price action. That's a lot of intuition on top of, obviously just the data that we've seen over the last week or so. But yeah, just my 2 cents on where we could be when it comes to just the market cycle now. But sorry for interrupting, Danny. I think you might have been.
No, I was just gonna say, well, since we're on the commodity space, why don't we look at copper? I know we've got a question come through, and it's obviously the chart is quite remarkable, as you can see. Definitely brings attention to the eyes. Now, we talked about a few weeks ago how copper had increased significantly on the back of Trump now announcing 50% tariffs on copper. This reversal now coming on the back of Trump announcing that the copper or refined metals were excluded from the tariffs. So that's when we saw price collapse. There is still going to be 50% tariffs. From what I read, I think 50% tariffs is going to be applied to semi-finished products. So let's say copper pipes or copper wires or rods, but copper itself, the raw materials are going to be excluded. And I think that's where we're seeing a lot of the momentum. Clearly just an undoing of some of that strengthening, but I think it's gone beyond that, as we can see, falling to what this is a 3-4 month low at this point, settling around that 4.4 mark there, trying to find a little bit of support higher. I think after a move like this, you're likely to see some counter trade coming in. It was a very, very fast move within a matter of 2 days. So obviously you're likely to see a little bit of reversal. But even then we can see that the daily moves are definitely being capped there. So clearly some resistance, but a lot of this move essentially just coming from those headlines, those tariff headlines, initially that 50% tariff and now being told that they are going to be excluded. So it is a very graphic chart, but it has been driven primarily by the tariff noise.
Yeah, and it's one of those ones that you just can't trade that really. Like,
Yeah.
you could have been lucky and on the right side of the trade because it was overbought and all those sorts of things. But that news completely came out of the blue. Good luck catching either the falling knife on that one or even just sort of entering it at the right level. So it's just a great illustration of just with how volatile the leadership in the United States is and how uncertain the policy backdrop happens to be, and some of the big changes that are trying to be made in the global economy, that you're just going to get these wild moves, and you've just got to be really careful, obviously, with managing risk in certain markets, because you can get things like that very quickly can either obviously go your way if you have the good fortune, or unfortunately not do the opposite, and you can end up in a pretty painful situation. So just almost a good cautionary tale, if anything else, because just that's such a difficult trade to basically get on the right side of, because it was so uncertain.
Yeah, and I think we have, before we move on from the commodity space, we do have a question on natural gas. So let's just pull up the chart. I think, yeah, we're coming from a little bit of a structural weakness story here as well. We can see from mid-June that bearish momentum, attempting a little bit of a recovery here last month, but clearly also falling through some key areas of support. The $3 mark being very, very important. We're now on the top side of it. For a very long time, copper was actually struggling to break above $3. That was just before the end of last year. So I think some of this coming from likely weather news. We know that natural gas is quite sensitive to weather and supply and structural constraints. So I think a lot of this coming from the back of that, likely to do with less demand for natural gas in terms of heating or cooling. But I think from a technical view here, you can see definitely struggling to break below $3. I think that's going to continue to be a key area of support. Definitely a place to watch out for. If we do get a close below that $3 mark, likely to see further weakness, because you can see in the last, eight months or so now, every time we've tested that $3 mark, you can see there's been a clear reversal, not managed to get a close below it. So if we're testing this level but not getting a close, potentially that could signal some further upside, some reversal. If you do get a close and a continuation of that bearish pattern below $3, I think that's definitely the sign that maybe the momentum has shifted and we've got a more long-term bearish bias in natural gas.
Yeah, well, I mean, it's just lovely when you see levels line up like that, because ultimately, at the end of the day, and I know we'll finish up in a second, but a lot's made of certain indicators, and whatever works for you as a trader is ultimately, whatever's profitable is what works at the end of the day. But realistically, the only thing that's sort of really backed by research in the long run in terms of actual continued efficacy, from like an empirical point of view, is levels, pretty much, support and resistance, and more or less people positioning themselves around key levels. Either that's managing a risk, putting a stop under potential level of support, or obviously entering a trade if a support level breaks, or same goes in the opposite for resistance. So when you do get that really lovely support line at around $3, those are the kind of things that I think, generally speaking, traders should be looking out for as opportunities, because you can't predict the future, obviously, and as much as you can prognosticate, there's always a great degree of uncertainty with that, especially in a market that is obviously fairly efficient at discounting information. You're competing against people with more resources and greater knowledge, but around those sorts of levels, that's often your best cue. So natural gas should be an interesting one. It's lining up in a really wonderful way. Yeah, Danny, it's 9:31 a.m. Where I am. Shall we leave it there?
Yeah, I think we've kind of covered. Didn't feel like we've talked about a lot, but I think we have talked about a lot. I think there was just a lot of it, of course, being around that labor data and how it's affected several branches of markets and policy. But yeah, as we said, not the busiest week on the calendar this week in terms of economic data. So it may just be seeing how markets adapt and kind of react to reassessing some of these positions. So it's going to be interesting to see how markets are able to kind of take that new information, all that information they got last week, and kind of play it into the current price. And of course, watching out for that Bank of England meeting on Thursday. Kyle, once again, thank you for joining. Thank you for joining, everyone, and we'll see you again next Monday. Oh, and I think we forgot to say the video will be on YouTube, right? So
yeah. If you want to watch back and share with your friends and tell your family and everybody else, that would be wonderful. We'll share the word.
Bye, guys. Thank you.
Bye.